Mailchimp raised $0 and sold for 12 billion. WeWork raised 22 billion and went bankrupt. Before you spend another minute thinking about how to raise capital, shouldn't you ask whether you're actually ready to? That's what we're discussing today on education. So on today's show, we're going to be talking about raising capital. I know our episode is, or our podcast is typically focused on, exiting and preparation for that exit. But for the investors and entrepreneurs out there that are uh, looking for that next stage of growth before exiting, obviously capital raising is a hugely fundamental step in that process. So we're going to go through a couple case studies. One, as we mentioned in the hook, MailChimp and WeWork, obviously larger examples, but the lessons from each of these are pretty applicable across various types of businesses. So um, just jumping right into it. So we had WeWork, as I had mentioned, they raised 22 billion. I think at their peak valuation, I think they were around 47 billion in
Mhm.
2019, and then in 2023 had to file for bankruptcy. And a lot of that was just, there's a lot of things we'll discuss in the episode, but ultimately it was a unprofitable business model that investors were still kind of chasing an increasingly higher valuation for the business, and ultimately floundered. And there's obviously some issues with the CEO that at the time, and obviously the unit economics of the business, which we'll
Yeah.
dive into a little bit. And secondly, we had Mailchimp, who
Well,
completely opposite approach.
just kind of pull back 1 second. WeWork, if everybody remembers, was the shared workspaces, both in person and online. Mailchimp is like an email blast service. I don't know if you guys remember those, where you could input whatever prompt you wanted, like a template, and you could actually mass select it and be able to send it out to all your users. So it's kind of like an internet blast
Yeah, it was an
tool.
email centric CRM tool, basically a way to, especially when email marketing over the late 2000s through the 2010s was a and still is, but
Hmm.
not so much now, just because of the the glut of it. But obviously, email marketing has always been a one of the strongest ways to remarket your existing customers within their database. So obviously, bootstrap company. Uh, I don't have the exact date in front of me when they started, but exited in 12 billion. Exited in 2021 for 12 billion, and what's remarkable about that is they were entirely bootstrapped. So completely opposite approach
Hmm.
to the WeWork venture capital model, and instead just really just reinvesting into the company, and just getting that growth over a long term period, and seeing a lot of success with it. So very great story with Mailchimp.
So yeah, we'll kind of go into what capital actually does and what it doesn't for you guys. So capital really amplifies what's already in motion. So if you have a strong business and capital, that usually equals growth. But if you have a broken business and you add capital to it, uh, you know it's an expensive failure that's meant to happen. So I would look at it as, usually whenever people go for raises, that, or some sort of targeted influx within capital. But anyway, when they do this, they're usually looking to expand and continue to grow. And so there's kind of two ways you can do this. The first way is obviously through some sort of debt instrument, but the second way is through investors. So either way, you're going to owe somebody something. It's just dependent upon your situation on what exactly do you want. In these cases, I believe both took equity, correct?
Yeah, I think with WeWork, they took a, because it is a real estate type company. They, I believe, also had some debt, but it was both of these were equity plays. And again, with Mailchimp, they didn't take on any equity outside funding, but certainly the case with WeWork. SoftBank
Hmm.
was one of the lead and largest investors in their build out over the 2010s.
Yeah. So a good reason to kind of raise is you have a working engine and you have capital that'll let you continue to expand and build on it a lot faster. One that gets people, there's obviously reasons not to raise capital. Some of them is urgency. So you need money to survive, not scale. Capital won't fix a cash flow problem. It only delays it. The other one is vanity. So raising capital can feel like validation. It isn't. Revenue is validation. I don't know if any of you guys have ever seen the TV show Silicon Valley, but there's always a funny joke in there they were going to raise capital, and they were so happy to produce a a revenue number, and the guy that was fronting the capital told him to stop. But it's a funny joke. But anywho, the third reason is imitation. Since everyone else is doing it, that's the most expensive reason in business. So just because you see peers raising capital, that's fine. And you also want to be cautious on how much you're actually raising at specific points. You don't ever want to kind of overshoot what your valuation is. You kind of want to strategically build it up so you don't start off with an immediate ridiculous sum for your valuation.
Yeah, and it's especially we'll go into this, but obviously a lot of our listening audience may not necessarily be the fast growth tech type of businesses that
Hmm.
would necessarily apply to kind of the VC funding model. But as we'll get into a little bit, the funding approaches have changed fairly dramatically from the let's call it the 2010s period, where you had a low interest rate environment and a lot more willingness to invest into pre-revenue startups, where it's really just getting users on your platform, and we'll figure out the economic model after the fact. Um, but especially for our more traditional run businesses, there's still going to be a you know, still going to need to be some soundness in, both your unit economics, your growth projections, and then also depending on, where you are with your company and, maybe if you have existing investors, you know, what's my ownership stake look like after raising the valuation? Is there an element of control that I'm losing?
Hmm.
Um, there's, you want to do a capital raise, but you don't necessarily want to. I mean, if you're 100% owner right now, and that control is still necessary for you, then obviously there's you know you're probably looking at maybe some growth capital that doesn't take too much off
No.
the overall ownership, majority ownership sake of the business. And there are private equity, growth oriented private equity firms that are a little bit more willing to take minority stakes, especially if you do have that runway and that growth trajectory that can still give them the output that they need after a 5 to 7 year hold period, let's say.
Hmm.
But still, it's exit will still be at the top of their mind for that. So, but another thing to consider too is just what's my what's the governance look like after it, my control look like after it. Obviously, there's going to be some board seat changes, but you still may be able to have the final say at the end of the day, depending on um, how that deal or that funding is structured.
Let's take a look at an example. We have what we discussed earlier, WeWork, which remember is the office space and online space that nobody really owned, but you can go in and kind of work. Uh, so they had long leases. The idea was to kind of sell like a subscription or a per time spot. The idea was to fill out the space and then re-rent at a premium. This only worked if occupancy was high.
Yeah, it's really just they're kind of just arbitraging the
No.
long term cost per square foot leases with higher premium, fragmented shared office space. So it seems like a good idea, and especially after in the early 2010s, obviously still kind of recovering from the Great Recession, and you know office long term office leases were fairly um, inexpensive. And then obviously you have this, kind of burgeoning, startup atmosphere again with kind of the lower interest rate environment and
Hmm.
willingness to invest in, um, a team of a couple people that don't need a big office, but obviously looking to, you know, grow over time and, expand their potential office footprint. It seemed like a really great idea, right? You have a, desired for some of these smaller, companies that are, want to expand at, their own pace and not be locked into something long term. And WeWork was kind of providing that our opportunity by having those long term leases. But
Yeah.
as we end up finding, um, in order to keep that occupancy high, and especially with the high, um, the high checks, the check sizes that they were getting from investors, and being valued at them being valued almost more of a tech company than what they fundamentally
Actually
were
were.
was a real
Yeah.
estate company. You're looking at subsidizing losses, and for some of those prominent businesses that came out of the 2010s, like an Uber, um, where you're trying to capture as much market share as possible with the everybody remembers the cheap Ubers of the
Yeah.
of the
Ubers, the
2010s.
lifts. Remember
um,
the lifts with the mustaches? That
and
was weird.
even Airbnb early on in terms of the kind of the sharing economy type platform businesses. You really to get that high growth and high user base on your platform, there's a lot of low providing a low cost entry point, something that can get users onto the platform quickly, and where the business proper value proposition really makes sense for the customers. But ultimately, on a real estate thing, you end up really finding that they were providing unsustainable leases, where these the leases that they were getting, the long term leases, weren't really being they weren't getting a high enough spread between the long term leases that they're that was their cost and match that with the short term um, rentals that they were subletting out at effectively, and you're not really getting enough premium, and eventually that money dries up, as we end up seeing. By 2019, they had to rush into an IPO because they weren't able to get their existing investors to re-up at a 40 we had a 47 billion valuation,
Yeah.
and ultimately
Well,
having to file for bankruptcy because the music has to stop at some point. I think investors are
yeah,
starting to
but I
realize.
mean, in 2018, they had 1.9 billion losses on a 1.8 billion
Yeah,
revenue in
right.
2018. So they were never profitable to begin with. And when the investors finally looked, they saw it. But I mean, like what Steven said, every new location only created more losses for them. Capital funded expansion of failure. And rushing to an IPO, as we all see, it never works for anybody. Actually, to this day, even in this market, that's why you see so many people scared to go to IPO right now. That's why you see these Series Gs, Series Fs, craziness. But who knows? But yeah, I mean, they filed Chapter 11 in 2013. I guess what to look at this was they did good for a good period until the fact that they wouldn't have done much better if they continued on this path. I mean, especially within the COVID reach. So
Yeah. Eventually, you have to prove the unit economic
yeah,
model right, or eventually your business model has to actually produce profits, right? And Uber, ultimately was able to do that. After that subsidizing um, of fares, for Uber rides. You, there is that
mhm,
period, when they did finally go public, where that $5 Uber is now $10 and
yeah,
whatnot, where they actually have to show unit economic profitability, but they but at that point they had captured enough market share, enough users on their platform where, and the convenience was, the value proposition was still largely there, where especially if you don't have if you're not in a city with a major taxi hub, you know even in the suburbs you can get an Uber. You're obviously not really seeing taxis on the roads
no,
on a regular basis. So there's still a demand, obviously, across the country, and not just high density urban areas, but also in the suburbs and whatnot, of needing that occasional rideshare fare. So, but ultimately, WeWork, and again, some of those startups that WeWork was probably catering to, again, there's probably a lot of pre-revenue companies that were taking leases there, and obviously, if the funding's not there to be able to
continue
lease
to
that
lose.
office space, you end up in a uh, predicament too, where you can't keep those users on it, and ultimately, it just ends up being, you know, it was consistently valued as kind of a tech platform play, but at the end of the day, it's
Real
just a
estate.
real estate company that's subletting long term leases for short term, and you're really not getting the spread there. And obviously, you have bloated costs and some poor management at the executive level. And
Yeah, I mean, SoftBank gave him 9.5 billion. This is a note from our producers in 9.58 or 9.5 billion in 2019, and that clearly didn't help because they filed Chapter 11 in 2023. But I guess we can move on then to Mailchimp because we can. I figured everybody has enough of that. But Mailchimp, once again, it was a kind of a tech corporation that allowed you to send out advertising through email, targeted blasts within different groups. They could, I think they were like one of the first people where you could actually see if people opened up your email, spectated it for X amount of time, your links, so forth and so on. And it was nice because you could actually set it up so it could do auto ones for you. I know they had at one point selective groups that you could choose from. So if you were doing a webinar presentation, you could select, half of your company or whoever you wanted to attend to. But overall, it was started in 2001 by Ben Chestnut and Dan Curizis. He bootstrapped it from a web design side project. They actually didn't raise a single dollar. The discipline was without outside capital, every decision had to be funded by customer revenue. That forces real rigor. So, kind of a little bit of a verbal meme here. You see a lot of these like AI companies, they'll raise like a $1 billion round, then next thing you know, you'll see the founder driving around in like a Ferrari or like a
Yeah.
Lamborghini. That's always the joke of raising capital. But if you're really disciplined with it and you're starting with your own capital, obviously you're going to treat it as if it's your own capital. I know some people that do end up receiving capital from outside sources don't always treat it as if it was theirs. But anywho, they had a runway. They were able to build it to 800 million in ARR, entirely on customer focused growth, no investor pressure, no board pressure. And let me tell you, they had a pretty successful outcome. They had a $12 billion exit. Founders owned the whole company, no cap table dilution. The money went to 2 people and their team. So once again, when we talk about dilution, every single time you raise money, you're going to have to kind of resplit that metaphorical pizza pie into more slices, right? So if you're bringing on somebody else, next thing you know, you kind of have to keep cutting somebody's slice down. So somebody ultimately has to get diluted in order for somebody to come in with a large check size to kind of keep you going. So if you're not going to raise money, obviously the pizza still looks as you originally ordered it.
Right. And they continue with that analogy. There's that, saying it's better to have a smaller, slice of a larger pie necessarily than, having all of a smaller pie. So, obviously that math has to kind of, shake out on your head. Obviously that you have to make the justification for raising outside capital,
Mhm.
where, if I am getting diluted down to, 50% or to 70%, I'm taking some money off the table. Is that 70% or is that 50% going to be, greater than what I can accomplish at 100%? So, that's something that is obviously going to be unique to, everyone's individual business. But if especially if you do see a lot of, high customer growth, and, we'll go into a couple, things here as far as, things you can, try to attempt to accomplish first before, um, you know, what are some internal options that you can
Yeah.
exhaust before taking on outside capital. But ultimately, if you are growing at a, fast clip, maybe not a ultra high growth startup, but obviously, you may have, found a niche business that's, growing really strongly, and, you know, taking on a loan or taking on, or just using the internal earnings from your company isn't enough to keep up with that growth, or you're leaving a lot of growth on the table. Then that's something where, taking outside capital can, obviously make a lot of sense. But again, before looking at those options, there's a couple of things to maybe look at. Is your customer revenue? Are you know, do you have enough earnings left over after you've paid your overhead, you've paid yourself? Are you able to, be, strict with how much you're paying yourself so that you can provide, instead of paying yourself $200,000, can you live off 100,000
Yeah.
so you can have that extra 100,000 being, added to, internal growth in your company? Um, what, is there room for, margin expansion? Whether it's, adding premium, and, if you are, growing at a high, clip, is there a more profitable solution where, if I can't sustain this, high customer, growth rate, do I have a pricing problem where I can, you know, get the pricing, increase the pricing to a level where I can sustain that growth, and then I've also been able to increase my margins maybe 5% to where I'm able to, keep the growth in check, charge a little bit of an extra premium on my,
Hmm.
product or service, and increase my margins from that as well. And then there's also working capital optimization. Obviously, are you paying your bills too quickly? Are you able to space that out in a way where you're able to hold on to cash a little bit longer? Than obviously on the counterpoint on receivables, are you doing everything you can to make sure you're converting on those quickly so that you have that cash coming in, and to be able to you know refunnel that into further growth? So a couple things to consider. And then obviously, if you're growing at such a clip and you've got a price point that you figured out and you still can't sustain that growth, and taking on outside capital can make a lot of sense.
Yeah, we do have a readiness test for you for, once again, the listener audience. We do have a slide deck on the actual visual, so please head over to YouTube to watch that. But we do have the five readiness test. So we want you guys to run these before any investor conversation, debt equity, or any other form of capital. I actually have one more for you here, but the first one is unit economics. Is one unit profitable on a fully loaded basis? If not, the capital won't fix it. The second one is use of funds. So usually you'll hear this a lot with people that are investing. They like to see exactly where you're actually going to use the funds. So grow your business is not the answer that people are looking for. They specifically want what you'll actually do with the money, whether it's for paying off debts or adding a new location or adding another product line, whatever it may be. They want to know, and they actually want to know how much it's going to cost and what the return will look like. The return math: does the capital justify its cost? Equity equals dilution. Once again, that's that pizza analogy. Debt equals interest and covenants. Model it before you raise it. The fourth one is operator capacity. Can your team actually deploy this capital? Capital without operational capacity creates chaos, not growth. And I know we have four up here, but I like to have a kind of a fifth one in mind. Just remember, when you have answered all four of these questions and you've decided to go with equity or debt, just remember, not all money is good money. So always be cautious of, who you're taking money from. Always seek out a professional, a lawyer, accountant, whoever it may be, to make sure that the terms are great so you don't get Facebooked, just like in the social media movie with Edward, whatever his name is. But just keep that in mind. All money is not good money. Just be cautious of what you're doing and how you seek to accomplish your goals.
Yeah, and then yeah, the one that didn't make it on the slide is what alternatives do you have? And again, going back to what I mentioned at the end of the last slide, have you been able to exhaust your internal funding options? So that's the customer funded
Hmm.
growth, supplier payment terms. Again, something I mentioned as far as can I extend the life of my payables? Working capital optimization, as a function or combination of those two. Revenue based financing. Capital should be the last lever, not the first. And again, going back to the unit economics. So we mentioned fully loaded basis. So imagine, let's say you're providing a service, and let's say it involves a tech. Obviously, there's the labor and material concept, but then also, can I, whatever my shared overhead is for that month, can I, if I know I'm doing 1,000 units of this service over the course of a month, and I know what my overhead is, divide that by 1,000, incorporate that into your unit economics. So that gets you your variable costs, your fixed costs, all produced into one economic unit, as we call it. And it really helps understand the profitability profile of your company, and something that a lot of investors look at as well. In the case of WeWork, it was, you know, we're paying this much for a long-term lease, we're charging this much for a short-term lease, and so that cost per square foot and revenue per square foot is kind of your unit economic
Hmm.
model. And obviously wasn't sustainable for the for the Mailchimp. Obviously it's a user based um, profitability. I have this is my average customer. I'm getting charged. I'm charging them X dollars a month. And obviously with these tech companies, it's the unit economics are usually really strong, because obviously it's ones and zeros are your unit cost. So every marginal um, unit effectively costs nothing. Obviously, it costs something, but that really helped enable them with that customer funded growth. Um, because the marginal cost was such. But obviously, in their instance, as we're talking fully loaded, you obviously have your staff of engineers and customer and marketing people, all being condensed down and divided into if they had you know 50,000 customers, you're dividing that cost, that shared overhead, by 50,000 to get to their unit economics. And I imagine they're probably in excess of 80% profitability on that. So um, really good to be sound on those numbers because it's certainly something, especially as you talk to growth investors, being sound on those numbers. And again, going into a couple of the others briefly, but really knowing what that money is going towards as you're looking to fund. Obviously, it, if you're looking at high growth, it's marketing, maybe new channels that you're looking to deploy into. Um, a lot of different facets, but also being really sound with your capital budgeting, um, where what the uses of funds is going to go into. Maybe it's some equipment, a lot of marketing, but just being really sound on where that money is going towards and how that's you know going into the financial math of the growth of your company.
Yeah, usually they have like a whole section dedicated to this. So like if you obviously are creating some sort of presentation for your fundraise, usually there's a whole section about where the actual proceeds are going to go to. So I wouldn't be, I just would never be too generic. Be as specific as possible within this, because once again, this is why they're buying into this organization. One, because they believe in you, and two, they want to see where their money's going to and what the return's going to be. Um, so on to the next, we do have actually six types of capital. Know the tool before you need it. So we have equity, which is what we were talking about. This usually comes from a VC, which is venture capital, or PE, private equity. Sometimes it can come from an individual, uh, whoever it may be. But you sell ownership, permanent dilution, which isn't bad. Investor has rights for high growth models that can't self fund. So this is where you'd see a lot of like kind of a good example of this, like the AI companies. They have to constantly keep putting money into the actual system in order to keep growing it and make it more efficient. But
Yeah, and just to not to split hairs, but
mhm,
for more traditional run businesses, obviously VC may not necessarily fit the profile
no,
of your business. But as I mentioned earlier, there is growth private equity, which is private equity typically takes two different forms. There's buyout, private equity, which is they're buying majority or full ownership of your company when you're looking to exit, and then growth equity, where in some cases they're willing to take minority stake in the company and help fuel that growth. If you're hitting double digit growth, which can still be accomplished with
yeah,
a more traditional style run business, they can help provide the funding to get you from point A to point B. So not all private equity is the same. So certainly you're not necessarily looking for a buyout from private equity, but certainly there's some growth private equity firms out there as well. So keep an eye out for that. Secondly, you have your traditional debt and bank, bank or SBA type of debt. So this could make a lot of sense. Obviously, you're not taking dilution from this, but obviously you have a lot of some it's fixed cash flow. So it's you have a debt service you're hitting every month that can sometimes constrain your ability to pivot if necessary. But if you're really hitting on certain growth, the idea is you should be able to pay it down either quickly or just have enough of a cash buffer to help protect against downside while it's still funding your growth. And obviously, if your growth is in far in excess of the interest rate of the debt, it can make a lot of sense because you're for every incremental dollar you're getting a lot more out of it, and that's just kind of the power of leverage there. So but super useful, especially for the physical equipment type stuff. Asset purchases, acquisitions, predictable repayment. I
yeah,
believe on next week or the next episode, we're going to have talk about acquisitions. So obviously makes as you're if you're looking to grow outside of your organic customer growth, there's some options where debt can be useful for that as well. But a lot of it, you can get better terms, obviously, if it's backed by collateral. So, if you are looking for equipment, debt's obviously a good option.
Yeah, we also have revenue-based financing. So this is kind of like taking an advance against your future revenue. You repay as like a percentage of revenue. There's no dilution. It's strong for recurring revenue businesses. So like if you have a big software or some sort of subscriber business, this is usually easier to do, especially if things are a little bit more predictable. Uh, just personally, I don't really recommend this. This fits like kind of a very small section of businesses, I think. But we'll move on to the next one. Obviously, please consult a professional before you do anything. Next one we have is seller financing. This one we've actually covered in episode 4. This is where, if I am looking to buy Steven's business, I don't have exactly the total amount of cash on hand to be able to pay for the whole thing. I might be able to pay for some, and then he might be able to give me a rate that I would have to, in return, pay him until the whole thing is paid off. Um, this kind of works for both people, like as the seller. So, for instance, Steven would pretty much have to make sure, or kind of is taking a bet that the business will continue to run as portrayed, even without him being there. So this is good for businesses that don't have a whole lot of owner dependency. And on my end, it makes the transaction a little bit easier because it kind of gives me a little bit of assurance that I know the business will be able to cover exactly what I will need to do as far as an interest payment going to actually Stephen would be.
Yeah, and this is particularly for those businesses. If you're running a business and looking to acquire another company, this is
Yeah.
where this would kind of fit in to this type of capital funding model. And it's we discussed a little bit in episode 4 of our series, and I think we'll probably get into a little bit of that in our next one as we talk about roll up acquisitions. But a really strong tool. Obviously, it's not for your internal growth funding, but more for if I'm find an attractive business, maybe it's smaller, with a guy looking to exit. There could be we're talking to an HVAC company that looks for smaller your retirement age owners, where he can get decent seller financing terms to take over their business and fold into his existing HVAC company. So certainly a appealing thing if you can get if you can structure it right and find those opportunities. And then lastly, real quick, we got mezzanine debt. This is you know typically in a private credit space where they there's going to be a bridge into a private equity buyout
And
with the intention, or with
an IPO as well.
yeah,
Usually this is the last round.
or it's something that private
Yeah.
equity may use to help with the financing of an acquisition. Something you probably wouldn't necessarily use for your own purposes as far as growth. There are some private credit opportunities, especially if you're um, if you have some sort of need to act on something quickly and you don't want to take dilution, there is, private credit channels available. You're probably looking at a higher interest rate than your traditional, like let's say an SBA type loan. But if you're kind of in a stage where you're, bigger than what the SBA would typically fund under, and you need a, need a gap to get from point A to point B. Typically, you want to make sure you're doing it with the
Mhm.
right, with a lot of right things in mind. But if there's a short term opportunity that you really can't pass up, where it just makes too much sense, that's something where
You
it's a
can
nice
explore.
alternative to some of these other options to be able to strike on something. But um, fairly um, small use case potentially in the context of using it for growth.
Next one is friends and family. Usually people call this, pre-seed rounds. These are within the growing and sort of capital raising life of a business cycle. You usually start off with an idea. You then have to put in your own money to the point where you kind of run out of money. So then you look towards your friends and family. Usually this is way before pre-revenue. You take on like this could be any sort of structure. It could be like a note, it could be a convertible debt sort of situation. Could be anything, but they're essentially there to help you progress forward. You always have to treat this like professional capital. I typically don't like for people to do this because you're risking two things for one thing. So you're risking usually the relationship of the person you're taking money from, um, which majority of the time it's not really a good case, but there's some select ones where, I'm sure it works out for everybody, but this is just kind of a undocumented early stage, you just need some money to keep things going. But I would try to remove yourself from that one, but we'll continue then. Um, but yeah, that's when to raise capital and when you're ready to it. Remember, Mailchimp built a $12 billion company without raising a single dollar. WeWork raised 22 billion and totally went bankrupt. So this has been
Yeah. So take a go look through the 5 readiness tests to see if your raising capital makes sense for you, and then obviously, if you want to work with a team or get some advice on some of your next steps, you can visit us at scgandco.com as well. In the next episode will be fun. We're going to be talking about consolidation, so be tuned for that.